Hello everyone, welcome to my YouTube channel. This is Accountancy for You. So today we'll be solving the first question of accounting ratios from T.S. Graval's analysis of financial statements. And this is 2023 edition, and I hope my video solves all the doubts you have regarding this question. So let's get started. First of all, the question asks us to calculate the current ratio from the following list of items. Right, so what is current ratio? Current ratio, which I've written as CR here, is equal to all the current assets of a company by the current liabilities of that company. Now, what are current assets? Current assets are those assets which come in the form of cash, or normal cash, money, or cash equivalents like our checks, or those assets which can be converted into cash and cash equivalents within a period of 12 months or the operating cycle of the business. Now, 12 months is usually the operating cycle of a business, but it can go more than that as well. Current liabilities, on the other hand, are all the liabilities that a company or business or firm has to repay within 12 months or within the period of the operating cycle of the business. Alright, so from this list, let's just try to pick out the current assets and current liabilities. Okay, so trade receivables, sundry debtors come under current assets because once the debtors pay us, it will be available in the form of cash, and that the debtor will pay us within one operating cycle. So we have the debtors, 7,20,000. Right, prepaid expenses is another form of current assets. So prepaid expenses, 1,60,000. The reason being, so suppose you paid something in advance, that is prepaid expenses, right? Suppose you paid the rent in advance. Then, imagining that you are not going to use the property for which you paid rent in the next couple of months, then the rent that you paid will have to be paid back to you. So you're going to receive it in the form of cash or cash equivalents, right? So that is why it is an asset, and since it can be converted into cash or cash equivalent, in the case of the prepaid expense getting reimbursed to us, then it becomes a current asset. So because of such a scenario, since such a scenario can arise, prepaid expenses, even though it is an expense, gets considered under current assets. Right, then the next point is directly given to us, cash and cash equivalents. That is definitely coming under current assets. That is 2 lakhs. Then we have marketable securities. Now, in the textbook, a hint has been given to us that marketable securities means the short-term investments. Now, we all know that in the balance sheet, under the asset side, we mainly have fixed assets coming, net fixed assets actually, that is after subtracting depreciation, and our investments coming. And these investments in the balance sheet are actually referring to long-term investments, that is over and above investments that can be converted into cash and cash equivalents over the period of 12 months or over the business's operating cycle. And then we have the current assets coming. So marketable securities, or the short-term investments, are investments within the 12 months of a business or within the operating cycle of the business. So they come under current assets. Right, so we have marketable securities. $2 lakh again. And then there's land and building. Now, land and building is a definite case of fixed asset, and fixed assets do not come under current assets. Alright, so land and building is not a current asset. Okay. Then we have bills payable. Now, current liabilities are those liabilities we have to pay within the business operating cycle, which is usually 12 months, right? So bills payable come under current liabilities because we have to pay off that bill within 12 months unless it is specified to be otherwise. So bills payable, which I'm just going to mention that's BP, comes around 80,000. sundry creditors. Now, just like debtors have to be paid off within the business's operating cycle, just like debtors have to pay us, sundry creditors have to be paid off within 12 months of the operating cycle. So our creditors come as 4 lakh. Now debentures. Debentures do not come under current liabilities or current assets. In fact, they come under debt because debenture is a type of long-term liability, and long-term liabilities come under debts. Only short-term liabilities come under current assets. Right? So debentures are not included. Inventories. Now inventories are a type of current assets because we sell off the inventory or stock. Inventories are also known as the stock of the business, of the company, the goods that the company is dealing in, right? So the inventories are current assets because they can be sold off to earn cash or cash equivalents, right? So we have to include inventories under our current assets. Okay. Then there are expenses payable. Now, the expenses payable are actually also known as outstanding expenses. And the outstanding expenses that a company has, it has to pay it off, clear out its dues by the end of the accounting period. So, our operating cycle. So, because of that, the outstanding expenses or the expenses payable come under current liabilities. Alright, so we add that as well. Which is 3,20,000. Now we just have to add up both the sides and find the ratio. Which will be 7,20,000 plus 1,60,000 plus 2 lakhs plus 2 lakhs plus 3,20,000 for the current assets, and 80,000 plus 4 lakh plus 3,20,000 for the current liabilities. And this is going to be equal to 16 lakhs for current assets by 8 lakhs as current liabilities. And when we solve this, the ratio comes to 2:1. And since this is the ideal ratio for current ratio, the company is performing very well and there are no idle funds. So that's the end of the question, and I hope that this is clear for everyone. So please do let me know how you feel about this video in the comment section, and don't forget to like, share and subscribe. Thank you.